Okay, hello ladies and gentlemen, and welcome to FXStreet.com's monthly webinar. This is part one, an open webinar entitled Trading Forex on a Daily Basis Using Daily Charts. Now later in the day I will be holding the premium portion of this webinar entitled Using the Principles of Confluence to Trade Forex Effectively. That's going to take place in about 2 hours from now. Now, hope all of you FX Street premium members out there can make it to that one. My name again is James Chen. I'm the Chief Technical Strategist at FX Solutions. In this webinar, this first part, I will be providing a lot of information on trading the daily time frame chart, which is my favorite time frame by far. I will be approaching the daily time frame chart from three angles: longer term position trading, medium term swing trading, and shorter term day trading. You'll see that all of these approaches work exceptionally well with the daily time frame chart. I will provide a general overview of how I like to trade Forex using these three approaches and show you a bunch of chart examples. In the end, I will be happy to take any questions. You could simply type them in on the chat window. And now, before I start, I would like to, as always, provide you with a brief introduction to myself, if you're not familiar with me or my work. Now, hopefully, all of you could hear me as well as see my my slides up here. This is the title slide I have up. Okay, great. So now I'm going to go ahead and give you just a brief overview of myself. Now, I've traded, many of you have already heard this before. I see a lot of familiar faces or familiar names here. But let me just go through this for those of you who are not familiar with me. I've traded actively as a private trader since the inception of retail Forex, which is pretty much back in 2000, 2001. That was a long time ago in the world of Forex. I use primarily technical analysis for trading the Forex market. I do use some fundamentals as well, but primarily I am a technical trader. I do take into consideration news announcements and the economics of the different nations involved. But primarily, again, I am a technical analyst. And I've worked for two major Forex brokers. Currently, I'm the Chief Technical Strategist at FX Solutions. I've been here for around 3 years at FX Solutions. Prior to that, I was at another Forex broker. Now, I'm registered as a commodity trading advisor, which means that I can trade funds, which I've done in the past. But currently, I am pretty much, I've got my hands full doing analysis and writing, etc., and doing webinars like this on behalf of FX Solutions. I'm also a chartered market technician, which is, if you're not familiar with that, is the designation for technical analysts, at least here in the States, but also internationally. So if you want to take a look at how you become a chartered market technician, you can go to mta.org. That's www.mta.org, and that is the Market Technicians Association. I've authored numerous articles. One recently came out in Forbes.com, my most recent one, as well as I've done a bunch of articles for Futures Magazine, Technical Analysis of Stocks and Commodities Magazine, SFO Magazine, which actually just, it's right now in the March issue. So you could take a look at my my outlook on the dollar. It's got some fundamentals as well as some technicals in there. So you could take a look at SFO Magazine. I've also got another article coming out in SFO in May. I've been quoted on a regular basis by Reuters News, Associated Press, International Herald Tribune. So if you see that, if you see my name in there, it happens. And now I also publish daily analysis. If you haven't seen it already, it's called Chart of the Day. And I put this on both on FXStreet.com as well as on our company website at FXSolutions.com, so you can take a look at that. I do a different analysis on a different currency pair each day, and I try to put as much technicals as possible in there. So you could take a look at that. Currently, we have the US dollar Japanese yen chart of the day up there. That's from yesterday. But as we've seen, there's been some huge movements going on after the FOMC meeting yesterday. So we'll see how that works out. Now, I also have a blog, and you could take a look. You can go to fxpath.fxstreet.com, where I update it on an intraday basis. So I have different types of analysis, announcements, and all kinds of other things in there that you can take a look at. and I think that would be very interesting for you if you're a technical Forex trader. And last but not least, I did just release a book this month. It's called Essentials of Foreign Exchange Trading, published by John Wiley & Sons, and it's now available on Amazon.com and in bookstores. And it contains all of the strategies that you're going to see here, but more in depth, as well as a bunch of other stuff. It has all the basics, as well as all the strategies, the technicals, the fundamentals, etc. All of that's in there, so you can take a look at that and check that out. So that's briefly about me. Now, let's go on. This webinar will be around an hour and a half. So we've got a lot of material to show here. I'm going to show you a bunch of live charts, as well as give you some explanations for my approach to trading Forex on daily charts using long-term, the three approaches: the long-term, the medium-term, and the short-term. Okay, with that, let's get started. Now, just a little bit about using daily charts, just an overview real quick. Daily charts, if you're not familiar with it, I'm sure most of you are if you're regular visitors of fxstreet.com. A daily chart is where each bar or candle represents one day. So, but this is different from the equities markets or the futures markets because of the fact that Forex is 24 hours. So, when you have a 24-hour market, each day, a new daily bar or candle opens the second after the previous one closes. So, basically, it's very hard to find gaps between bars or candles on daily charts because of the fact that it's basically the next bar or candle opens a second after the previous one closes. So you don't have what you see in the equities markets or the futures markets where you're going to be seeing gaps between the bars. Now, many Forex traders focus exclusively on trading off daily charts, although dailies can also be used within multiple time frame strategies. Now, I also have another webinar here on fxstreet.com, a recorded webinar that you can take a look at. It's called Multiple Time Frame Trading. Now, on that, I often use the daily chart as one of the time frames, as one of the anchor time frames, because as you all may probably, if you've seen my chart of the day, may be familiar with the fact that I've almost primarily or almost exclusively used the daily chart for that. But when I'm trading from a multiple time frame basis, I'm going to be using the daily chart in conjunction with, for example, the weekly chart and the 4-hour chart, the hour chart, etc. But, many traders focus exclusively on trading, just the dailies, which, for me is also the case. I'm pretty much a daily chart trader. Now, technical analysis tends to work better on higher time frames, like the daily charts, due to less noise. I think the daily chart is really the best, the best thing in between the longer time frame charts, which, like the weekly and the monthly, which are harder to trade because of the fact that, everything moves really, it takes a long time to make any substantial movement. But in terms of the daily charts, you've got the good medium between, clear trending, as well as, your ability to actually trade the chart practically, from a time frame basis. Now, the shorter time frame charts are going to have a lot of noise, as you're probably well aware, especially when you get into the minute charts, etc. So again, I like to look at the daily charts because trends tend to be much clearer on daily charts than on shorter time frame charts, etc. So and you've probably seen that already. Now, different traders look at all different time frames, but the common time frame that most traders have used to some extent is the daily. Now, if you take a look at, if, for example, let's take the weekly chart. You ask the typical Forex trader, have you ever traded off the weekly chart? Some will say yes, and a few may say that's their main time frame to trade, but very few. Now, if you ask someone, do you trade the 4-hour chart? They may say, yeah, on occasion, but and some may exclusively use the 4-hour chart. But when it comes to the primary time frame of choice, most traders will have at least used the daily chart to some extent, and many of them are exclusively daily chart traders. Now, daily charts are the obvious choice for long-term position trading, and I'm going to show you that. I'm going to show you the tools I use for long-term position trading on these slides, as well as on the charts. I have a bunch of charts to show you. So, for example, if you're talking about long-term position trading, trading with the trend, trend following, then the daily charts are really the obvious choice, and really they're the minimum time frame to use. Now, when you go down to swing trading, which I also do a lot of, daily charts are the ideal choice for this type of trading. Yeah, some people use whether the 4-hour chart, the 3-hour chart, or the 12-hour chart, or the 1-hour chart for swing trading. Those are all fine, but in general, I find that, in my opinion, daily charts are the ideal choice for swing trading as well as for long-term position trading. Now, lastly, but not least, in terms of short-term and day trading, many people are not aware that they can use, the daily charts are very effective for this type of trading. Most people will go down to much shorter time frame charts. Now, I'm going to show you today how I approach short-term trading using daily charts. Now, sometimes I do use the when I'm trading on a short-term basis. Sometimes I do go down onto the shorter time frames, but in general, I like to stick to the daily charts because you could see everything. Everything's much clearer on the daily chart, and you could put everything in good context on the daily chart while trading short-term, short-term, as opposed to flipping back and forth between the longer time frames and the shorter time frames. I like to generally stick to one time frame, that being the daily chart, and looking at seeing clearly the trend and what's happening with the on an overall basis with the currency pair, and also trading off of the daily chart on a short-term basis. So, and when you talk about these different types of trading, long-term, medium-term, short-term, I generally don't think of myself either as a long-term, medium-term, or a short-term trader. What I generally think of is I'm looking for opportunities, whether they be long-term, medium-term, or short-term. I'm not, primarily or exclusively either one of these. I'm just looking for opportunities, whether they happen on, during any of these approaches to the market. Okay, so that's very briefly regarding using daily charts. Now, the tools of daily chart trading. And, if you've read any of my analysis, I like to stress price action a lot. And price action is simply, a lot of people have different definitions of price action. I like to think of price action as, really analyzing and looking at price without having a lot of noise, or, a lot of people like to have lots of indicators, etc., on their chart. I like to stick to certain fundamental rules and tools for technically trading the Forex market. And this includes probably my most important tool, which is the horizontal support and resistance. And this is basically, there are many ways to measure horizontal support and resistance. The way I like to do it is looking for previous turns and reversals in the market where price has pivoted in the past. And those are good examples of where, price may, again, pivot in the future, or if you're looking for breakouts or breakdowns, etc. So that's exactly what I look for when I'm looking for horizontal support and resistance. And I'll show you an example of that in a second. There are other ways to measure horizontal support and resistance, including Fibonacci retracements, as well as pivot, the actual mathematically calculated pivot points, and you could certainly use those. And I've included that within these tools of daily chart trading as well. Next in importance are my trend lines, and you'll see trend lines all over my chart. I'll show you my euro-dollar chart in a second. Trend lines all over the place. So I like to use those. Those are called dynamic support and resistance, as opposed to horizontal support and resistance, which are static, which stay the same. So let's say 1.3 on the euro-dollar. Let's say that's a support and resistance level. That's static. Okay, that's horizontal. Trend lines are dynamic, where you have a slope. Usually it's uptrend support, or downtrend resistance, and those are trend lines. Those prices change according to the slope of the trend line, and I'll show you that in a second as well. Beyond that, we have parallel trend channels. Parallel trend channels are simply ideal trends where not only in an uptrend, for example, not only do you have uptrend support, but you have uptrend resistance as well. In a downtrend, not only do you have downtrend resistance, but you have downtrend support as well. I'll show you examples of that graphically. Chart patterns, and these include such patterns, continuation patterns like the flags and the pennants, which I had actually, just as an aside, I have one on the U.S. dollar Japanese yen on the daily chart, which failed today because it was never broken out to the upside, and it broke down in a tremendous fashion to the downside, as you'll see in a second. So chart patterns are continuation patterns and reversal patterns. Chart patterns being like flags and pennants and triangles, etc. Reversal patterns being like head and shoulders, double tops, triple tops, that type of thing. Bars and candle patterns. When I'm talking about that, I'm talking, for example, which I use one bar candle or bar pattern that I use a lot is the what many people call the Pinocchio pattern. It's a single bar pattern, which is akin to the hammers and the shooting stars for the candles. We also have engulfing patterns, etc. So those can also be used very effectively for daily chart trading. We have the oscillators, and the oscillators mainly I use for swing trading and range trading. And as many of you may know, if you've seen my any of my analysis, I use slow stochastics pretty extensively. I also use RSI sometimes and CCI, but you got a bunch of oscillators there that basically do the same general thing. They're all different in a way, but they generally do the same thing, which is talk about momentum, overbought, oversold, that type of thing. And again, I use that primarily in swing trading. Moving averages, those many people may use for looking at crossovers. I don't generally do that. I mainly use moving averages for the slope to look for trend, as well as separation to look for how strongly separation between or among many different moving averages to look at the strength of a trend. Many of you may be familiar with the Guppy multiple moving averages, and those talk about separation of moving averages to talk about the strength of a trend. Also, I look for moving averages to denote support and resistance as well. I don't often look at crossovers, which is probably the most popular way to look at moving averages, but they're dangerous because of the whipsaw that's involved. Okay, so next is Bollinger Bands. I use that sometimes in conjunction primarily with swing trading and range trading, which I'll show you in a second. And then Fibonacci retracements I use very, very, very often. And those, I only use them because they're primarily a self-fulfilling prophecy, which I'll explain in a second. And that, especially the 38.2% retracement is very good for that because lots of people are looking at that. So I'll show you that in a second as well. And then, sometimes I also use the ADX, which is the average directional index, along with the DMI plus, DMI minus. And these are indicators created by Wells Wilder, a guy back in the day who created a lot of different indicators. This one happens to be a especially good one, along with the ATR, the average true range, which I like a lot. But the ADX and the DMI plus and minus, they're used primarily for checking, in terms of the strength of a trend and whether a trend is, maybe ending or beginning. So those are the tools of daily chart trading, pretty much in order of importance that I use them. And, if any of you want, this is going to be a recorded webinar, so you could take a look at this at your leisure, but if any of you want these slides that I have, feel free to email me. I'll give you my email address at the end. Okay, so briefly to go through all of these, different tools that I use, I'm just going to go through them real quick. Most of you know what this is, horizontal support and resistance lines. If you take a look at this picture on the left, these are all from my book, by the way, and these are taken from actual charts. So here, for example, on the left, you've got this very strong support. I think these are all daily charts. Very strong support here, and then a breakdown here. But any of these could be played in using the daily chart. All the way on the right here, you see this screenshot here is a bunch of horizontal support and resistance lines. Again, this is the way I define my horizontal support and resistance is where price pivoted in the past, turned or pivoted in the past. These are not pivot points, but they're places where they turned in the past, and they're good indications of where traders may look to push price to turn in the future. Okay. So these are some examples of horizontal support and resistance lines. We've got trend lines, like I said before. Trend lines are the path of least resistance. Trade with the prevailing momentum. Enter at high probability points. You've got uptrend support and downtrend resistance. What do I mean by that? Again, this is dynamic support and resistance, which means the price changes according to the slope of the trend line. So if you have this uptrend here, you see the slope of this uptrend. Support will change according to the slope of the line. So generally speaking, when you have an uptrend line, you have dynamic support on the bottom here. And generally speaking, when you have a downtrend line, you have downtrend resistance on the top here. Okay? And most of you are familiar with that. Usually it's not as precise as this, as you'll see. These are real charts again, but usually it's not as, of course, for my book, I picked and chose the best possible examples, and these are probably the best you'll find. But they're great indications of trend and dynamic support and resistance. Okay, next, parallel trend channels. These are parallel lines that show both support and resistance during uptrends and downtrends. For uptrends, for example, you have, like I said before, generally for an uptrend line, you have uptrend support on the bottom. But an ideal uptrend is uptrend support and uptrend resistance, as you can see here. Uptrend support, uptrend resistance. That's an ideal trend. So for uptrends, higher highs as well as higher lows. And for downtrends, not only do you have the downtrend resistance here, you also have the downtrend support. And that, again, is an ideal downtrend. Now, be careful at the same time of taking counter-trend trades on these channels. That is, on a downtrend, your best bet is probably to go short at the top and probably not to go long at the bottom. Same way on an uptrend, best bet is to go long on the bottom and probably not short on the top. But that's up to you. There are many successful counter-trend traders out there. Okay, so those are parallel trend channels. Now, patterns. Now, I'm only putting continuation patterns here because this is all I'm going to cover today in terms of chart patterns. Continuation patterns. I'm not really going to talk about the reversal patterns, for a certain reason, and you'll see in a second. So chart patterns, I've got the triangles. These are usually considered continuation patterns. I got flags and pennants. Now, flags and pennants, as you'll see on the dollar-yen chart, I was looking for a continuation of the possible uptrend, but that did not occur, and it broke to the downside. But it wasn't a flag to begin with, if that was the case, because it never broke to the upside. So these happen all the time on your charts, flags and pennants, and then we've got wedges, falling wedges, rising wedges. Those are also continuation patterns, as well as rectangles, which can be continuation patterns or reversal patterns. But in this instance, I'm going to be talking about all of these with respect to their continuation qualities. Okay, and these you would all trade breakouts of the borders. Okay, so those are chart patterns. These are all tools for daily chart trading, and I'm going to put them into certain buckets for you to separate them between long-term trading, medium-term trading, and short-term trading. So these are the bar and candle patterns that I primarily use, and the ones that I use the most, if you've seen any of these webinars that I do or any of my analysis, the ones that I primarily use are the ones with the long wicks. When I say long wicks, when I'm looking at a candle, I'm looking at, for example, a shooting star. Anything with a long wick, it's a huge signal right there. These long wicks are huge signals, especially on daily charts. If you're talking on an hourly chart or a 30-minute chart or something like that, the long wicks are not going to be as significant as they are with daily charts. So you'll see it on daily charts. If you have long wicks like this, especially the ones like, for example, the hammer that goes down like this and then comes back up, or the shooting star that goes up like this and comes back down, then especially with those types of patterns, which these are also called Pinocchio bars or pin bars for bars. For the for those of you who don't follow candles, but these are extremely good signals, especially at potential turning points, and to be used in conjunction with other types of signals. Okay, but these are all the candle patterns that I generally look at. But again, I'm looking at the long wicks, especially in terms of the hammer and the shooting star. Okay, so that's the bar and candle patterns. And then we've got moving averages. I'm going to quickly go over this. This is, again, I use them primarily as trend slope indicators. And I'll show you on the euro dollar in a second how it worked very well there. But here, for example, I've got uptrend support using the using this trend line. I'm sorry, this moving average right here. Okay, and here you have a cross of two moving averages. But again, I don't use that very often because of the the very frequent whipsaws and the lag involved with that type of thing. Okay, so those are the moving averages, also tools that you could use. Bollinger Bands, again, I use them primarily. Some people, for example, you take a look at this towards the right-hand side of the screenshot here. Some people are looking for that type of thing. Actually, this is called the squeeze. If you've ever read any of John Bollinger's work, the squeeze is where you have a contraction of volatility and then a breakout in one direction or another. So this is a perfect example of that. You got a squeeze of the Bollinger Bands and then a breakout to the downside. I don't generally use this that much. I generally look for ranges and where there are turns after it hits hits one side of the Bollinger Bands. Okay, but this happens to be a good example of the Bollinger Band squeeze right here. Okay, so those are the Bollinger Bands, and then I've got Fibonacci retracements. Again, I use regarding. I have this question here: does squeeze, is it a continuation pattern in Bollinger Bands? No, it's not really a continuation pattern. It's more of a breakout pattern with the Bollinger Bands. So you're looking for it's a volatility breakout. So you're looking for a contraction, a squeeze to a very low volatility, and then sort of an explosion in one direction. So that's the squeeze, and then a breakout to the upside or to the downside. It works pretty well. Now Fibonacci retracements. Here you have I've outlined here. This is a perfect example again from my book, but a perfect example of a Fibonacci retracement here. You've got an uptrend here, and then you've got a retracement down to the 38.2% retracement level, and then a continuation on up. Now, the most important Fibonacci retracement levels are 38.2, 50, and 61.8, and not because those are magic numbers, but because of the fact that most people are looking at those levels. I don't believe in magic numbers at all, but I believe that because Fibonacci retracements are followed so closely, it becomes what's called a self-fulfilling prophecy, where people are following, so many people are looking at and following these levels and acting upon these levels. This includes retail traders like you may be, or an institutional trader. They're looking at these levels and they're acting upon these levels, and it becomes a self-fulfilling prophecy. So that's why they work so well. Most importantly, 38.2%, 61.8%, and 50%. Okay, so that's Fibonacci retracements. And then finally, ADX DMI, which is just measures the strength of a trend and not the direction. For direction, you would use DMI, which is the directional movement indicator. And you have the DMI plus and minus. I'm not really going to go over ADX too much, but I do use that occasionally, especially in terms of the long-term trading on the daily charts that I do. So ADX, just very briefly, if you're increasing, some people say that increasing ADX values above 20 suggests increasing trend strength, while decreasing ADX values below 40 suggests decreasing trend strength. And others say, the 30 line on the ADX is the line of demarcation between trending and non-trending. So you could take that as you will. It really it's from your own experience how you want to work with the ADX. But that I would use as a trend following tool to look for trends in, if I'm scanning different currency pairs to look for opportunities. Okay. Now, long-term position trading. This is my basic strategy for long-term position trading. One of my primary strategies, okay? Using daily charts. You enter and hold positions in the direction of the overall trend. That's obvious. Now, position trading, trend following, that type of thing, you're going to be looking at the daily charts, but you're looking for longer-term positions, and your entry would generally be on short-term breaks within the long-term trends. And I've done, several webinars on this, so some of you may be familiar with that, but I'll show you this on the chart as well. So you're entering short-term breaks within long-term trends, and then you're holding it as long as the trend continues using trailing stops. So, and I talk a lot about manual trailing stops, and I think many of you heard that before, but when I talk about manual trailing stops, in terms of locking in your profits, if the trend continues to go in your direction, you're moving the stop manually at different dips or pullbacks in the market to lock in your long-term position. But generally, in terms of entry, again, it's your short-term breaks within long-term trends. Short-term breaks. What do I mean by that? Breaks of patterns, breaks of short-term trend lines, breaks of short-term support resistance lines within in the direction of the long-term trend. You're playing those breaks, and then you're holding as long as the trend continues. Okay. The tools used: price action, of course, which includes horizontal support and resistance, trend lines. I'll show you this on the chart. Trend lines, parallel trend channels, chart patterns, bar and candle patterns, moving averages, Fibonacci retracements, ADX, along with DMI plus and DMI minus. Okay, those are the tools I use for long-term position trading on the daily charts. Medium-term swing trading. Medium-term swing trading, again, on the daily charts. I trade swings in the context of the trend or a range. Okay, so, a lot of people may define swing trading as range trading, which, I definitely do not do that. Swing trading encompasses both, trading a trend or trading a range. Swing trading is, in terms of defining swing trading, I would define it as trading, I hate to use the same word in my definition, but trading swings in the market. And swings being, the up and down movements within the context of either a range or a trend. Okay, so whether it's going up and down between two support and resistance levels, or whether it's going up and down in an uptrend or up and down in a downtrend, you're trading those swings. Now, when you're trading in a range situation, you're trading up and down. Generally, when I swing trade in a trending situation, for example, in an uptrend, I would trade only long at the lows, and then if I'm trading a downtrend, I'm trading only short at the highs. Yes, from one price pivot to another. Okay, so Joe defined that pretty well. One price pivot to the next, I'm trading pivots in the market. That's the swing trading. Now the question: breakout is a swing with a retracement. Not necessarily. Breakout trading is different from swing trading, but I'll show you exactly what I mean on my charts. Now the tools I use for swing trading, whether it be for a range or a trend. And by the way, the exit would be at the end of each swing. How do you know the end of each swing is taking place? You would look at either, for example, a trend channel or a horizontal range, support and resistance, or you would look at an oscillator when it goes to the other side. Okay, that's the way I use oscillators. Okay, so the tools used for medium-term swing trading would be price action, horizontal support and resistance, trend lines, parallel trend channels, bar and candle patterns, oscillators, very important, and sometimes Bollinger Bands as well. Okay, so those are the tools I use for swing trading, and I'll show you all those how all those tools come into play on my charts. So that's medium-term swing trading. Okay, short-term and day trading. Now, this is what many of you may not be familiar with in terms of daily charts. Most of you will be day trading or short-term trading on, a minute chart, a 5-minute chart, a 15-minute chart, 30-minute, 1 hour, sometimes up to 3 and 4 hour, but probably not. And almost most of you will not even look at short-term trading or day trading on a daily chart. But that's what I want to show you today. So daily charts for short-term and day trading. What I'm looking for is single and double bar analysis. Okay, this is pure price action. I'm not talking about a bunch of indicators. I'm talking about your trading based off of pure price action, which includes such elements as double tests or double test failures, and breakouts of those double tests, or triple tests or quadruple tests, but basically double tests and long wicks. And you're exploiting quick turns or breakouts, but mostly I'm looking for quick turns. And you're doing all of this in the direction of the trend. And how best to look at the trend, but to look at the daily charts. Okay, so you're looking at daily charts. You're looking at daily charts, and you're seeing the trend clearly on your charts. Then, for the short-term or day trading, you're looking for the double tests or the triple tests, and you're looking for long wicks. And you're exploiting those quick turns in the market. How you get out, that's up to you. But some people may get out with moving their stops, as in a manual trailing stop or or an automated trailing stop or what have you. Harley asks, is there an advantage to using bars instead of candles? Do you get enough info? Bars and candles, to me, are primarily the same thing. They give the same information. Candles just have those patterns that you like to look at. I've worked very extensively with Steve Nissen, and his candle patterns are phenomenal. But at the same time, all the same information is in the bars as are in the candles. It's just easier to read on the candles. Okay, especially those great candle patterns that he brought over from Japan. But generally speaking, bars or candles, you can use either. So you're looking for double tests or long wicks. Long wicks are long, on the bars. It's I don't know what you call it, but basically you're looking for those long things on the end of the bar or candle, and you're exploiting quick turns. The tools I use are very, very few. Price action, which includes the horizontal support and resistance, and the bar and candle patterns. Okay, so those are the very few. You don't need much more when you're day trading or short-term trading. And I'm not trying to say that short-term trading and day trading are easy, whether it be on the daily chart or the 5-minute chart or what have you. Day trading and short-term trading are much harder, and riskier, in my opinion. But I'm going to show you a way to do it, very effectively on daily charts. Okay, so before I get to my, I'm just going to show you some chart examples from a bunch of charts that I have. Before I get to that, does anyone have any questions about what I just talked about? Okay, hopefully everyone could see that there. We got some huge moves yesterday and today. Crazy moves after the FOMC yesterday. But let me see. Now, should I ABS? Should I only do analysis in order to determine entry point following the trend in daily chart? What time frame should I do on a smaller time frame? Like I said, most of what I do is primarily on the daily chart. You could certainly go on to the lower time frames, but I do most of all of my analysis as well as my trading on my daily chart, and I'll show you that in terms of the long term as well as the short term and the medium term. What time of your daily chart of the day completed? It's usually at around before noon, U.S. Eastern time. I'm in the New York area, so that's when it's usually done. What chart platform do I use? I use my company's FX Solutions, which is called FX AccuCharts, and you see that right in front of you right now. Okay, Boyke, I'm going to get to the single and double bar analysis in a second. Now, this is the chart of the euro dollar. I use this a lot in my daily charts. I'm sorry, in my webinars as well as my analysis, because most of you trade euro dollar very extensively. It's the most traded pair. It's the most liquid pair available. Okay, so most of you trade that. That's why I use it so often. And so many of you may see all these patterns that I have on my euro dollar chart. Many of you have seen it before in my prior webinars. I do that for a reason, because this is probably the most important pair for most of you. But I'm going to show you a bunch of others. I have 6 other pairs to show you. Okay, so let's go through this real quick. Now, this I'm going to be approaching from a long-term basis. I'm going to show you all the tools that I use. Okay, and again, many of you have seen this before, but I have some new stuff towards the right side of my screen. So just to give you a brief overview, we have an uptrend here, and this started back in 2006, early 2006. Okay, we got, of course, back in 2006, you didn't know this was occurring, but after a short time, you saw that there was indeed an uptrend. Given the slope of the moving average as well as the uptrend line, that worked out pretty well. Now, during the when I talk about long-term trading using daily charts, and I'm going to show you all daily charts, of course, today. So when I'm talking about long-term trading, I'm talking about short-term breakouts of within the direction of long-term trades. So if you take a look here, I've got an uptrend here. It's a pretty obvious uptrend, and you see that I'm having short-term breaks. These are breaks of short-term downtrend lines or counter-trend lines within the context of the uptrend. The counter-trend lines are simply consolidation or retracement within the context of the longer-term trend. Okay, longer-term trend is up. You've got counter-trend lines here, and you're playing breaks of those. It occurred several times. Okay, now you also got here, within the context of the uptrend. We're still in an uptrend here. You've got a break of the patterns, okay, a pattern break. And this patterns, like the flag and the pennant, they simply represent consolidations within the context of the trend. These, again, are continuation patterns, okay? So consolidation in the flag, and then a breakout to the upside, okay? And then same thing with the pennant I have here, a breakout to the upside. This one didn't work out so well because there wasn't much follow through there, but nonetheless, there was a breakout to the upside within the context of the uptrend. Okay. Again, here you got a counter trend. I'm sorry, I just moved that. You've got a counter trend line. This again is all long-term trading. Okay. You've got a counter trend line, a break of which would be a signal to go in the direction of the trend, to go long in the direction of the trend in this case. Long-term. This is long-term position trading. Short-term breaks within long-term trends, okay? So you've got an accelerated uptrend here, as you can see. An accelerated uptrend here, and here you have a horizontal resistance line here, a break of which turns into a continuation. So a short-term break of this horizontal support resistance line turns into a continuation in the direction of the trend, okay? What is my stochastic setting? Let me give you that real quick. 1433. That's what I use. Okay. So, so you have, again, here you have a break, a break right here, a break of a short-term horizontal support and resistance line in the direction of the trend. Okay, we're still in an uptrend here. We're still looking for additional reasons to get into this trade long. Okay, even though we're at record highs, even here was a record high, here was a record high. So even though we're doing that, we're trend following. So we're following the long-term trend. Yeah, we're at record highs, but you know, at all these points we're at record highs, and it still broke to the upside. So we're still looking for breaks to the upside. Okay. So at this point, what happens? We've got a consolidation. Okay, a consolidation, and then as you can see here, a consolidation, and these were all. We're still looking for an upside here, and you know, perhaps here when we hit the 1.6 area, a good key psychological level, we're looking for a breakout above 1.6. Okay, it didn't happen. It was it poked its head a little bit above 1.6, but then it came back down. Okay, so that was considered a double test, and then it came back down, and then at this point during this range, you see here we have established support here. I'm sorry, this is a little low. Let me put this up here. Okay, we have established support here. Hopefully you can all see my charts. It's a little hard to see because I have to make this screen a little smaller for the recording. But if you take a look here, this is you know, established support, and then you're playing a breakout there. Okay, and at this point, you're still not in a downtrend. Okay, so you know, you don't know this is going to occur, but at some point you see that first of all, slope of the moving average. Second of all, you're seeing that a breakdown of the troughs in between the double test, the double top. Okay, in between the double top, you've got the trough here, as you can see. A breakdown of that, technically speaking, is a confirmation of a potential reversal. Okay, the trough between double tops, or the peak between double bottoms, just like you saw in the dollar yen lately. You had a double bottom, and you had a peak between them. The breakout above that peak, that was around 94.60. A breakout above that peak was a confirmation of a change in trend. Okay, so this is the same thing way back around last year, mid-year. Okay, you had two troughs in this case between the double top, and you had a breakdown, and that was a confirmation of a possible trend and change in trend. Okay, and the question: what about stop loss and entry point? Entry point, you could use, you know, in terms of these long-term trades, you could use a short-term. You know, again, what I'm doing is short-term breaks, counter-trend breaks, or breaks of patterns in the direction of the trend. How do you get in? You could use a filter. A filter being, you know, for example, a number of pips beyond the break, 10 pips, 20 pips beyond the break. I don't happen to use that. What I like to use is, you know, for example, if there's a break, I would wait for the breakout bar, the bar that actually breaks out to close. You know, again, this is on the daily chart. A breakout of the bar to close, and then for the next bar to surpass the higher low of the breakout bar. And that's when I get in. That's my filter that I use to enter. Some people may use number of pips beyond the break. Okay? Other people may use other things, but that's how I do it. Now, how do you exit? The way I exit on a long-term trade, and this is different from my medium-term or short-term trades. The long-term trade, again, I like to use, especially for the, you know, the longer trending, you know, times. I like to use the manual trailing stop. And I've talked about this many, many times before. Manual trailing stop is where you, you know, you change the stop loss to where you, you know, you manually change the stop loss. So it's less arbitrary than an automated trailing stop. An automated trailing stop trails the market by a number of pips. Okay, what is the moving average I use? I generally use 50 simple moving average. As you know, 50 simple moving average I use as you know, support and resistance often, and it worked in this case, as you can see. This was resistance here. You know, it works sometimes as that, but mostly I use it for slope. Now I use a 50, I use a 100 simple moving average as well as a 200 simple moving average. Why do I use that? There's no magic numbers there. I use it because a lot of people use it, and you could use exponential too. Not much of a difference there. Okay, so. You've got these breaks here of, you know, at this point, first of all, if you take a look here, you have an uptrend, the accelerated uptrend here. Hopefully I'm not talking too fast and you could all understand it, but I tend to talk fast. No, in terms of the moving average setting, it doesn't make a big difference. It's your preference. I like to look at moving averages that most people like to look at, only because I'm looking for that self-fulfilling prophecy. Okay, so you got this accelerated uptrend here, and you've got a pretty good accelerated uptrend. And you know, during this range here, you see a breakdown right here of that accelerated uptrend, and then you see a breakdown of the trough here. That's a good sign right there that the trend is in fact changing. Okay, so now you're looking at a possible downtrend. You don't know yet, but it's a possible downtrend. This break is a good clue. This breakdown right here. Okay, so when this break occurs, what happens? You get into a situation where it continues down, and then it gets into a situation now where you're looking at the slope of the moving average, your chosen moving average. You're looking at the slope turn to the downside. Okay, that's not the main indicator. It's just one of the confirmations I use. Okay, but you're looking at you know, price action here, a break of the uptrend line, a break of the trough between double tops, and then you're looking at a move down, and then a flag pattern there, and move down from there. Okay, so you know, this is a break of a short-term pattern within a long-term, within a potentially long-term trend. Okay, as we move forward, we go down, and then we hit a retracement within the net. Now it's pretty well known that it's a downtrend. Okay, this is back in you know, September 2008. So then we got an uptrend here. I'm sorry, an upwards retracement here, going to uptrend retracement here, going to the moving average, and then we've got a turn, and then a move back down, and the break of this short-term uptrend line right here. In this case, it could be called an uptrend channel, short-term uptrend channel, but basically you're looking at the uptrend right here, a breakdown, and it continues on down. Now you're really in a downtrend. Okay, so it continues on down here. That break could have been played, and then it played into a inverted pennant pattern. Okay, and then again, short-term pattern, short-term break within long-term trend. It broke down to the downside, and then it went to a triangle. At this point, Boyke, what stops do I use? I generally use, when I first get into a trade, into a short-term breakout of a long-term trend, when I first get into that trade, what I'm using is, you know, I'm putting the stop loss a little bit behind the point of break. Okay, but once I'm in the trade, then I'm using a manually trailing stop. Do you need fib extensions? I don't generally use it. Sometimes I use fib extensions. Fib retracements, I use them mostly as measurements of retracements, and I'll show you that. I have a fib retracement right here, okay, and that's another tool that I use for the long-term trade, okay, and hopefully this isn't really confusing for all of you. I got a lot of stuff on my charts, but anyway, so you've got this this continuing downtrend, and then consolidation within the inverted pennant, and then you go down into a triangle pattern here. At this triangle pattern, you're looking for a breakdown to the downside. You're still in a downtrend. Who knows it was gonna go up like that during the holidays last year. But it went down into a very nice triangle pattern. I'm looking for a break to the downside. Again, short-term pattern, long-term trend. I'm looking for a break to the downside. It didn't happen. It broke to the upside. That's okay, because I didn't get in. There was no break to the downside. So it broke to the upside. This, I stayed out of. This whole thing right here, I stayed out of. This was during, this was the high volatility during the end of last year, low liquidity, and it made a huge move all the way up here. But what did this huge move represent? Okay, I'm going to make my chart a little smaller so you can see. What did the huge move represent? 100. I'm sorry. From this top, this second test of 1.6 down to this low down here, it was a 61.8% move. Okay, so that's why at that point I thought perhaps this is just a retracement. And and it happened during the low liquidity of the holidays. So perhaps this is just retracement, and we're going to look for further downside. So 61.8%, that occurred. It went a little bit beyond it, and then it dropped down tremendously from there. Yep, at magic number 61.8%. Again, I don't believe in magic numbers, but a lot of people do, so I'll follow the people that do. Okay, so so at that point, you know, you had this move here, but generally speaking, we're still in a downtrend. As you can see, you have this downtrend line here, and then you have a triangle pattern that occurred here. Another triangle pattern. This is a descending triangle, or you know, you could look at it as a possible pennant to the upside. Okay, so if this is a pennant to the upside, a break to the upside would have prompted a you know, going long, but instead it breaks to the downside, and this is you know, and this was what a lot of people are expecting after what happened at the end of the year. After this sort of false move happened at the end of the year, people were expecting it to go back down. So you know, it did go back down. It broke down, and then you know, at that point, people were thinking it's going to continue, and then so you have you know, a little uptrend here. You could call this a flag. You could call it whatever you call it. It's a retracement or consolidation within you know, what may be called a downtrend at this point. So this occurs several times, and then you get into this downtrend here, and then of course recently it was broken to the upside, and then you know, technically speaking, the technicals pretty much went out the window yesterday and today after what happened after the FOMC. So that, you know, that break to the upside was unexpected. But as you can see here, we got a little downtrend line here that you know, coincidentally or not, I don't know, it went up to this downtrend line. Okay, so that's the euro dollar. Now I'm going to go to the next one real quick. Okay. Now this is the infamous chart of the day from yesterday. Okay. I was looking for there was a confirmed uptrend, okay, because we have this you know, this is again, like I was talking about before, with the troughs between the double tops in euro dollar. We've got the double bottom here, okay, potential double bottom with a peak right here. The peak occurred right around 94.50, 94.60, okay, right here. So when this occurred, when a break above that occurred, we're in a confirmed change of trend. Okay, whether it continues or not, that's up to price action. But we're at that point in a confirmed uptrend. Okay, after the break of the you know, according to the rules of this type of pattern. Okay, which is a double bottom. Above the peak, we're in a confirmed uptrend. I was looking for consolidation here, and then a break to the upside. It didn't happen. What happened was it moved all the way back down to the bottom of the pennant, and then it broke to the bottom of the pennant. Now at the bottom of this pennant, now it hit support right here. Let me see what the price was so far, 94.47. So around at the support, the resistance becomes support. So you got resistance here, you got support here, and that's where it hit. Okay, just so happened to hit like that. So at this point, we are in jeopardy of having, and also you got the support here. I'm sorry, you got this uptrend line right here. Okay, this uptrend line here is providing support as well. Okay, so what happens there is, you know, at this point, if there's a breakdown below this 94.50 level, a significant breakdown, we're looking at, you know, a failure in the uptrend because it's breaking down below the, you know, below this peak. Okay, so that's just a little bit of the current technicals. Now, this is just to show you more of what I'm talking about in terms of short-term trends. You know, I'm sorry, short-term breaks of long-term trends. So you had a long-term downtrend here, and then you had breaks of this inverted pennant. You had a break of an uptrend line, and you had a break of this another inverted pennant here. All of this is pretty good in terms of you know, getting into the trade, and then you can follow it up with you know, with manual trailing stops, and then it gets down to this point. Okay, now there's a double test right here. Okay, where is this double test? It's around 87, just above 87. Okay, double test here. I'm looking for it to go lower. It doesn't. Okay, it goes back up. All right, and then it hits what could be a double bottom. Now, a double bottom doesn't occur unless there's a break of the peak in between. So it's not called a double bottom yet. Okay. Now again, then you've got a downtrend line here, a triangle here, a breakout above that could have been played because it's a possibility. If you're anticipating a double bottom, you're anticipating a change in trend at that point when this double bottom gets hit, and then it was confirmed with the break above the peak. Okay. Okay. Now the question: what do you depend on setting the manual trailing stop? You don't have a setting for the manual trailing stop. I'm sorry. How do I set the manual trailing stop? Basically, what I do is, I move the stop to, let's say I'm playing a breakout to the upside in an uptrend. Okay, so every time there's any type of consolidation or any type of retracement, I'm going to be preferably in a long-term trade. I'm going to be moving my stop to right underneath that retracement or that consolidation. That's how I do my manual trailing stops. Okay. It's very, very subjective. So, but you could certainly learn to do it that way. So that's probably the best way I know of moving a manual trailing stop. Okay, so this is the U.S. dollar Japanese yen. Now, daily chart, of course. Now let me go ahead and. I'm sorry. Okay, now from a swing trading basis. Okay, this is mainly the way I approach swing trading. Okay, now what do I have on my charts? The tools I just talked about. Okay, this is again it's the medium-term swing trading basis. Now this is the British pound against U.S. dollar. Again, it's a daily chart. Okay, so on this daily chart, the British pound against the U.S. dollar, I'm looking for places to play the swings. Okay, I'm not looking to stay in long-term like I am with the long-term trading. I'm looking for, every market will never go up or down exclusively. It will go up and down. So if you're in an uptrend, as you all know, this is obvious, of course, but in an uptrend, it's going to be oscillating up and down. And in those, that's a key word, oscillating. Okay. Now, what do we do when we're looking for oscillations within an uptrend, within a downtrend, or within a sideways trend? We're looking at oscillators. Okay. Oscillators. A lot of people think oscillators really don't work. I tend to disagree with that. Oscillators work very well as confirmation tools, especially when you're trading the up and down oscillations within trends or ranges. Okay, so I've got an uptrend here, and it's a little hard to see, but because this is I got a lot of stuff here. Now I'm looking for confirmations on several levels. I'm looking for not only am I looking for turns on the oscillator, in this case the 1433 slow stochastics, which I use. You may use RSI or what have you. But for me, I would use the stochastics, and then at each of these points, I'm looking for several different things. I'm looking for, chart patterns. I'm sorry, bar patterns that'll show me that there's a possibility of a turn in the market. Okay, and for that, I'm looking for example, double tests or triple tests, and I'm looking for candle patterns with long wicks. Okay, so at this point, and very importantly, I'm looking at the oscillator. Now, when I look at the oscillator, especially with something like the slow stochastics, I'm going to be looking for an emergence from oversold to go long, or an emergence from overbought to go short. Now, I use this also in conjunction with my trend lines. Okay. Okay, so here, we've got a trend line with that's pretty valid here. Okay. So at this point, you got a couple different touches, and then here you got a touch here. This trend line you may not have seen, way back here. I'm just putting this as an example, but you've got, a trend line here and you've got a very obvious push off from oversold and an emergence up. And then what I usually do is I try to, in terms of my exits on the swing trades, I would get out when it goes into overbought in the case of a long. Okay. Same thing, for all of these. For example, here I've got a double test of the low here, as you can see here, and then a confirmation with this emergence from oversold, and then I'm looking to get out when it goes to the other end, which in this case would be overbought. Same thing here, long wicks, okay, at the bottom of the uptrend line, and I'm looking for a confirmation on the oscillators to go long at that point, and then I'm getting out at the other end. Okay, this is just one way to trade medium term, swing trading, and any of these trades will take anywhere from 3 days to a week or two. Yes, Andrew, I'm getting out as soon as stochastics crosses the 80 mark. For stochastics, for RSI, I usually have the 30-70. For stochastics, I have 80-20. It does matter, but that's just from your own experience, what works best for you. And Suki, yes, this webinar will be uploaded to FX Street, soon. Okay, so same thing here. I've got a long wick, after a down run, and this is called a hammer, and I'm looking for, an uptrend here, and it doesn't actually go here, so that's not a very good trade. Okay, so that's in an uptrend situation. I'm looking for the swings, and again, during the uptrends, I'm looking for to go long, to go with the trend, and during downtrends, I'm looking to go short at the top. Now, you could certainly, it would have been very good if any of you went short at any of these areas, but that's a counter trend trade that I tend to stay away from. Many people don't. Many people have lots of success with it, and if you do, that's great. But if you're a beginner, I would tend to stick with the trend trades. Okay, now here we see example here of you've got a candle pattern here in conjunction with, and this is during a sideways a sideways non-trending situation here where you've got some support here. I'm sorry, the support should be a little lower. Okay, the support here, and you've got this hammer right here after a down run, in conjunction with a turn from oversold, a turn up. Okay, in conjunction with if you're looking at a sideways action, you're looking at the Bollinger Bands as well, and a touch of the of the bottom here. Some people might use that as well. So so that's a good place where you have a confluence of different factors. And I'm going to be giving a webinar in a second, or I'm sorry, in about an hour on the principles of confluence. So I'll show you all about that if you're a premium member. But anyway, so you got the same type of thing, over here. Okay, so two different areas where you got different confirming factors for a potential range trade or a potential swing trade. Okay, now here also I have a longer term trade. Now you're in a downtrend situation. You've got this retracement up, okay, and then a breakdown, etc. So you have just like what I was showing you before. Okay, and then here as well, towards the bottom, I have places right here where there are possibilities to go, as you can see, on a downtrend. Before we had an uptrend, on a downtrend, we have places to go short. We got the stochastics, we've got the candle pattern, and we've got a new downtrend line. And here we have another example of that right here. Okay, these are medium-term swing trades. Okay, here we have a breakout. This is real-time chart, so we got a breakout above this downtrend channel, and there's no confirmation to go short here. Okay. Reward to risk. I try to make the reward to risk as ideally you're going to want to have at least. I don't want to make any concrete rules here, but ideally you would like at least 2 to 1, but and preferably 3 to 1 or more. But sometimes that can't. It's hard to make that the case. So what I generally tend to do is make my upside as unlimited as I can, especially in terms of the long-term trades, because I'm going to be looking to do manual trailing stops. So I want to make my upside unlimited, and my downside I'm going to put it just behind the point of break. Like for example, in a long-term trade, if I play the break here, on this breakdown of this inverted flag, if I play the breakdown here, I'm going to want to put my stop loss a little bit above that, above the point of break, and then I'm looking for a manual trailing stop. Okay. Hopefully that all makes sense. Okay, so that's basically some examples I use for swing trading. Just a couple more examples real quick, and then I'm going to get to the short term. Okay, so hopefully you can all see my Australian dollar, US dollar daily chart. Again, these are all daily charts. Yeah, Rod, yes, I would wait for the daily candle to close for entry. Okay, I would wait for the daily candle to close for entry, and then the next candle to move beyond that breakout candle. That's my filter. Okay, and my filter that I use, you could use something different. How I trail the stop? I trail the stop by once it gets into profit. It's very subjective. But once it gets into profit after the breakout, once it gets into the profit, then I would trail. I would move my stop after any consolidation, or just before the point of consolidation or retracement, if that makes sense. Just so if it goes against me, then that trade becomes invalid. If you have any questions about this, I could certainly put this in an email. I'll put my email up in a minute. Okay, so this is my Aussie dollar, Australian dollar against the US dollar pair. Again, I have this downtrend here. It's all the same thing from a long-term basis. I have my downtrend here, and I've got my breakdown in the direction of the short-term breakdown of this pennant, in the direction of the trend, and then another pennant here, etc. Okay, and from a medium-term trading perspective, I've got my little trades here, where I've got an uptrend line here, as you can see, and then I've got my candle here. Okay, a good candle here in conjunction with an emergence from oversold. Okay. And then a move up from there. That's a short, medium-term trade, probably about a week. Same thing here, an emergence from oversold, and also adhering to the uptrend line. Okay, and that's a short-term trade. And right when it hits, you would have gotten out a little bit early in this case, but that's a short-term trade nonetheless. I'm sorry, medium-term. Okay, so that's my Aussie dollar, a little bit of long-term, a little bit of medium-term. Okay, now, is it wiser to wait for a pullback? Yes, I talk a lot about pullbacks in terms of my breakout trades. That's another filter that you use. I use it very often. Along with my close and then move beyond the close, I will often use a filter in a pullback or a throwback. A pullback being to the downside, a throwback being to the upside, and I'll often look for that to make it a higher probability breakout trade. So yes, definitely pullbacks and throwbacks are very useful. What trading platform do I use? I use, my company's GTS Pro. Okay, so that's the Aussie dollar. Now let me go quickly over to this. Okay, now I'm going to talk a little bit about short-term trading. Okay, short-term trading is not easy, okay, but it can be done very effectively with daily charts. Okay, now I'm going to go backwards here. I'm going to start from over here. And this, again, is a euro-dollar chart, again, because all of you, or most of you, are traders of the euro-dollar. Okay, so what I'm mainly doing when I'm looking at short-term trading on daily charts is I'm looking for pure price action. What do I mean by that? I'm looking for areas on the chart where I see double, triple tests, also in the direction of the trend, as well as candle patterns. Okay, so when you take and if you're trading from a short-term or day trading perspective, you probably don't want to be jumping back and forth between different time frames because there's not a lot of time for that. So what I like to do is, when I'm trading on a short-term basis, I like to just keep on one time frame because I'm scanning a bunch of different currency pairs. I don't want to be scanning a bunch of different currency pairs plus a bunch of different time frames on a bunch of different currency pairs. So I'm going to be looking at one time frame. Generally speaking, it's a daily time frame, but I will sometimes be going on to lower time frames. But this is how you do it on a daily basis, or how I do it on a daily basis, daily chart time frame basis. I'm looking for price action elements, which are candles or bars that have long wicks or long tails, and as well as double, triple tests. Okay, so when you're looking at the euro dollar, for example, one second, let me just say something. Okay, when you're looking at the euro dollar, for example, at this point right here, okay, when you break down below, for example, you break down below this support line, okay, so you're in a confirmed change of trend after this double top. The breakdown below the trough, you're in a confirmed you're confirmed change of trend or confirmed reversal at that point. Okay, so you got to break down there. Now, at that point, you're always looking for retracements or consolidations. Okay, and then you're playing those retracements or consolidations, often in the direction of the trend. So at this point, you see a very clean double test here. Okay, at that point, what do? You could get in on a short-term trade at the break of the second test. Okay, so and then what I often will do is employ a trailing entry. Okay, if any of you are familiar with that, a trailing entry would just be if you let me see 1 second. Trailing entry stop. So if you play the breakout here, okay, if a breakout doesn't occur, that's fine, and then you would move the entry up if it keeps going up. Okay, but if a break does occur, you get into the trade, and you're following the trade in the direction of the trend. Okay. Now this could be, and you're trading the break of the second test in this case. Okay, and you're also looking for example, these long bars here. I'm sorry, these long wicks here. Okay, so I've had a bunch of different ones on my chart. Okay, and then what I usually do is play the break. If you have a long wick, for example, you're playing the break of that. You're playing the break of that bar. If you have a double test, you're playing the break of the second bar in the double test. Okay, and then you could hold that for a day, or as long as you wish to. But from a short-term basis, that's basically what you're looking for. And I have a bunch of examples here. Okay, so again, once you have the breakdown of the trough here, you've got you got a double test here, and then you've got another example here of a longer wick. Or, I'm sorry, a double test right here. If you take a look at that, a double test that's separated by two other candles. Okay, and if you missed it here, this is a confirmation or a reinforcement of that, and then you're looking to go short at that point. And of course, short-term trades can turn into long-term trades depending upon your exit for the short-term trade. So if you're exiting on the end of the next bar, then that's a very short-term trade. But if you're holding it open by moving your stops, then it could turn into a medium-term or a longer-term trade. Okay, so you're looking for price action in the terms of these tests, preferably in the direction of the trend. Now, at the same time, you're also looking for things like this, which is, in this case, this is a hammer. And this is a very good hammer, and you're looking to possibly go long at that point for a short-term, play on the on that particular pattern. So in this case, it would be a break above, this type of a hammer. So, okay, let me just answer a few of these questions here. The current candle, do you need to wait for confirmation before making a play correctly? In daily trading, it's harder to look for confirmations. The main principle that I'm looking for is price action in the direction of the trend. So, and when you have a double test, that in itself, from a day trading perspective, would be, and if it's in the direction of the trend, would be a good way to get into, a short-term trade like that. Okay, without a lot of confirmation, because you especially in during if you're trading a short-term move, then you don't have time to look for a lot of confirmations. Okay, but basically what I'm doing is I'm looking for these types of price action on all of the different currency pairs. So every currency pair that I'm looking at, I'm going to be looking for opportunities where if there's a double or triple test, any type of price action element like a double or triple test, where the traders found it hard to get beyond the previous day, then I'm looking for a reversal at that point, or I'm looking for a long wick, whether it be a hammer or a shooting star, and I'm looking to get in on the day after that pattern occurs. Okay, with a break, like for example, if you have, for example, this doji right here. Then you're looking for a break above it, and this happened to work very well. But and then you could trail your stop very easily at that point. Same thing with here. You're looking for a break. This didn't work out so well, but you have a break at this point right here where my mouse is, and then at that point, you're looking for a reversal. So here as well, if you take a look here, you got a very long wick. This would be called a shooting star. This is unreliable because it happened during the low liquidity time, but nonetheless, you're looking for a break below, in this case, break below the candle, this candle pattern, this single candle pattern. Okay, and a confirmation here as well on this long wick. Yes, the problem here, Din, is correct. Is noticing while it's happening. That's why, if you use a daily chart, you're actually noticing it right after it happens, because you're taking the pattern from the day before, okay, and then you're trading a breakout of the day before's pattern. So, yeah, it is hard to do it. But if you're looking at all of the different currencies, and you're looking for all of these, whether it be double tests or long wicks, etc., then you're looking for breakouts in the other direction. Then you basically you're doing the day after. Andrew, on the right-hand edge. Well, this is this is very bare. There's nothing I could see in terms of a short-term trade right here. This is this is very bullish at this point. And then if you take a look at my, let me take a look back here. It has hit resistance up here on the downtrend line, but from a short-term basis, there's not a lot in terms of price action that you could say there from what's going on the right-hand edge. Okay, so hopefully that makes sense. I have a bunch of different examples here as well. Okay, so here, if you take a look here, and this is, again, this is on a very short-term basis, you've got pretty much a quadruple test here. Okay, if you take a look back here. And on this quadruple test, you're looking for a breakdown below, whether it be the second test or the third test or the fourth test, you're looking for a breakdown and a play in that manner. Okay, so hopefully that makes sense. That's how I would approach it from a short-term basis. Let me take a look at the next one real quick. And then finally, this is my last chart I'm going to show. This is another one from a long-term basis. Again, short-term breaks within the long-term trend. This is the British pound against the Japanese yen. And as you can see, all the examples here. Now, if any of you, well, here, if you take a look right now, this is on the British pound against the Japanese yen. I've got a rising wedge here towards the bottom, and we're still in a downtrend. So what we had here is a rising wedge, a breakdown of which it pulled back up to the bottom border of the wedge, and then a possibility to move down. If there's a break below the bottom of the the low right here, I would call that very, very bearish. Okay. So hopefully that makes sense. I've shown a lot of charts here, and I think we're running out of time. We've got about 4 minutes. If any of you have any questions, let me go back real quick. Okay. So any additional questions that you may have, please feel free to contact me by email. I can be reached at jchen@fxsoul.com. You can check out my chart of the day at fxsolutions.com, as well as my blog at fxpath.fxstreet.com. You can look for my book, Essentials of Foreign Exchange Trading, on Amazon.com in the market. So with that, if you have any questions, please do feel free to email me. And thank you very much for your time.